Welcome back to this month's edition of CAP STRAT Wealth Updates. I got a lot to share with you here today. First, we're going to jump into private wealth updates, but then we're going to shift gears and talk about taxes. Obviously, tax season just wrapped up here, and it really puts the wheels in motion in regards to our planning, but also it's an opportunity to take a step back and reflect on what happened last year. Based on some of the information we'll show, there's a lot to reflect on, and it's really just information to be aware of. So we're super excited to bring that section to you here today. So Carrie, why don't we kick it off with private wealth updates, and I'll let you take it from here.
So the IRS has issued new guidance for certain required minimum distributions from inherited IRAs. So several years ago, the IRS eliminated the possibility of using what was known as the stretch rule, which gave people the option to draw down their inherited IRA balances over the course of their life expectancy. So now, certain people have to take required minimum distributions from their inherited IRAs over 10 years, which has caused a lot of confusion. So for 2024, for most people, you don't need to take an RMD from your inherited IRA. However, that doesn't necessarily mean that you shouldn't. This is a tax planning question, which really perfectly ties into the rest of our content for our video today.
Yeah, and even thinking about the IRS guidelines and the updates more recent that they just posted recently, that's been the same update over the last few years at this point. Mm-hmm. And if you inherited an IRA account and you're subject to that 10-year distribution rule now, and you have not taken any distributions at this point, that window's starting to close. Mm-hmm. And something you want to be mindful of, especially as you look at the income taxes that will be applied to those distributions and the timing of that. So we're going to shift gears to our main topic here today and just talking further about taxes. And first taking a look at what happened last year. Because part of our process is here in May, we're going to start gathering all the tax returns that have been completed here just at the April deadline. Mm-hmm. And we understand that a lot of folks have filed for extension, and we'll be working with them individually throughout the year. But this is an opportunity to start to just understand what happened and, in a sense, looking in the rearview mirror. What we like to just also mention is that not a lot of advisors are going to really dig this deep into that. And especially when we talk to a lot of new individuals and families, the current advisors are not even requesting the tax return or even reviewing that. And from our view is how do you help manage someone's entire wealth without knowing the tax profile?
Right.
It's very difficult to do. So let's jump into it. And first, Carrie, if you want to kick it off and maybe highlight some other reasons why this is important.
Like you were just saying, a lot of advisors kind of assume that their clients are at the top marginal tax bracket. However, especially as we see people transitioning to retirement or really have all kinds of different reasons for why their income may have dropped, we really can't determine any tax planning opportunities that exist if we can't review the tax return. So this is a really big value add that we really implement for a lot of our clients. Another reason why this is helpful is because it can allow you to plan your cash flow a little bit better. Yeah. We see a lot of people that need to cut quite a large check at the end of the year, or at the end of the tax year rather, and if you can plan for withholding or estimates, what have you, it can just make your cash flow a lot smoother throughout the year.
Yeah, we always like to say this, avoiding tax bombs is important, especially as a lot of activity happens throughout the year, whether it's portfolio related or just personal income related. Really updating all this information before the end of the year is important to gain that visibility.
We see a lot of very complex tax returns, and it's quite possible that an important item could have been missed.
We have a sample tax report, and again, this is looking in the rearview mirror, that will just highlight some of the items that this brings together. Obviously, a tax return can be anywhere from, say, 25 pages to 100 pages, and especially when you get that return, you may ask, like, what does this all mean? So this is a nice way to really compress it, bring it together, and walk through some of the highlights here. So where do you want to begin?
Let's start with deductions. A lot of people are familiar with, tax deductions, but there are really two main ways that you can note your deductions on your tax return. Understanding if you are itemizing or taking the standard deduction.
Yeah.
Currently, the standard deduction is higher than we've seen in past years, and so a lot of people are taking the standard deduction, but understanding if you were close to itemizing,
Right.
perhaps in 2024, there could be ways to better organize your deductions.
Kind of the four main deductions that are out there today: state and local income taxes, which is really your real estate taxes, and you're going to be capped at $10,000. Charitable gifts.
Yep.
That's super important because a lot of families think they're getting a tax deduction for it, but if you're itemizing, or if you're not itemizing, then you're not.
Right.
Medical expenses is another one that goes into it.
Mortgage interest.
And mortgage interest. Thank you. We do find that sometimes these items are missed, and those are important to factors to just be checking along the way, especially as you review your return once it's completed.
Right. And one last note on this too, sometimes these can change from year to year. Sometimes people itemize in one year, sometimes they take the standard deduction. So having an open communication about what your deduction situation is going to look like for the current year can help us advise you and just have that clear communication.
Awesome. What's next?
Well, understanding your marginal rate is also super important. It is an important benchmark to know at what tax bracket your income is leveling off into.
Right.
So if there are opportunities to fill up the lower marginal tax bracket and not creep up into the higher one, those are opportunities we want to look for too.
Yeah, and this is essentially every dollar earned the next dollar earned is what's going to be taxed at too.
Right.
So super important when we're thinking about even Roth conversions or thinking about capital gains of ultimately what the tax is on those. I'm going to touch on carry forward losses. This is really important to continue to monitor, just based on any tax loss harvesting at the end of the year. And a good example is we have a newer client that came in and reviewed their tax return, and they had substantial carry forward losses out there. That creates a lot of planning opportunities, especially if you have embedded capital gains on legacy positions or growth positions that you may want to start to right size relative to your overall risk tolerance itself. So that is something to continue to monitor. These carried forward losses you can carry forward for your lifetime and your spouse's lifetime, but once you pass, those are gone. So again, important to continue to monitor to make sure you're not leaving those on the table if that opportunity is there. Yeah, our report will actually give you a safe harbor number, which is basically the safety net of what you need to pay to avoid any additional penalties there. And again, we find this time and time again that there might have been under withholding, that you want to make sure that you're working closely with your accountant to right size that and to avoid paying any additional penalties there.
Right. Also, Neil, can you tell us a little bit more about Medicare premium surcharges? We see that a lot.
Yeah. Deeper down in this report, not highlighted here, we'll start to measure ultimately where your Medicare premiums will land. Keep in mind this is from, say, for example, 2023. This will impact your Medicare premiums in 2025. So there's always that delay there. But going back into visibility and making sure you have the right expectations, you at least will know what will be adjusted. So let's talk about going forward. Obviously, this is all good information, and typically it is in the past.
Right.
And as of 12/31 of the prior year, you really can't make many changes there. But you can make a lot of changes and start planning for the future, and I think that's the next section we'll talk about next.
So this is a snapshot of the tax planning software that we use, and it's great because it allows us to model future scenarios that haven't necessarily happened yet. It can allow us to look at the trickle-down effects of, for instance, what happens if I implement a Roth conversion in this year? What's going to happen to my taxes in future years? So this is a process that we're starting now, and that we will utilize your 2023 tax return in order to build these projections going forward. A lot of different, as we were just talking about, a lot of different planning opportunities affect your income, which ultimately affects your taxes. And these are things that we want to just model out and talk about throughout the rest of the year.
Yeah, and I think it's important to start to build that base case scenario, which usually is coming off of a prior year understanding, but we know some clients have retired or their income status has changed, just based on what they're collecting. And that's where it comes back to the communication side, and as we discussed throughout the year, to make sure that we're updating that profile, especially as we think about the future. A lot of tax laws sunset here in 2026, beginning in 2026. So just understanding the trade-offs of current tax rates versus future tax rates, and how that might be impacted for your own personal take-home pay. So those are things that we want to be mindful of. What else are we looking at on a regular basis here?
Well, going back to really helping you manage your entire financial picture, if we don't understand your current tax rate, it might be difficult for us to recommend the correct investments for your situation.
That's
so determining if taxable bonds or municipal bonds make the most sense, that's all driven off your projected tax bracket.
Right. And in that case, we always say it's not what you earn, it's what you keep, right? So those are things that are important. We talked about stacking donations. There's a lot of modeling that we'll build into this to make sure that maybe you're exceeding that standard deduction amount and maximizing those tax write-offs at that point. Future required minimum distribution planning.
Right.
It's a big one to understand. Do you start converting today, potentially at a specific tax rate, versus what your required minimum distributions are going to look like when that happens at age 73 or 75. Again, having visibility into that can just help make better decisions and understand the impact, because at the end of the day, you're going to owe taxes on this money, and do you do that now, pay that now, or do you pay that later?
Right. A similar situation too that you just jogged my memory. We have a lot of conversations helping people determine if it makes more sense to donate highly appreciated stock, or if you are subject to required minimum distributions, it might make sense to make a qualified charitable distribution.
Exactly.
And with this analysis here, we can really show you side by side the end game, really, what one's going to be most efficient for you depending on your income.
Right. Going back to it's not what you earn, it's what you keep.
Yep.
And if you can do things more efficiently by understanding the entire profile and having visibility into that, it's going to be a win for everyone that's part of that relationship.
Exactly. Neil, can you tell us more about how we advise people, particularly self-employed people, on the best retirement vehicles that they can use to save?
Yeah. There's a lot of different options there, depending on the income that you have and the potential other employees that you might have in place or not. But this is, again, using the software and understanding what your net income is, can understand the impact of pre-tax, or now for a lot of solo 401k plans, you can do Roth structure with that too. So do you pay the taxes now, or do you pay the taxes later, is something that we're actively looking at. But then tying that to the type of plan, because there's a lot of different self-employment retirement plans available out there that just want to make sure you're going down the right path and putting your dollars in the correct one. It's not only going to maximize your contribution amount, but potentially your deductions on that too.
Right.
Every client situation is unique, and obviously that's what we're here to help with. To not only from a conversation standpoint, but also to try to simplify it in such a way that it's easy to understand, but then also present it in a way that helps make better decisions going forward. That's our objective here, especially as we look at taxes overall, which we know can be super complicated, and our objective is to bring that more simplistic value to the discussion to clarify where you're at today and how do you maximize that going forward. Okay? So that concludes our topic here today. Keep an eye out next month in regards to that communication to upload your tax return for our wealth advisory clients. We look forward to digging into this with you one-on-one, and certainly we'll talk to you soon.